don't have a full portfolio. If you scan the QR code on the back of my card, it takes you to my website. It's more of a landing page. It's still kind of under construction. But I do have social media that shows some stuff. But I have pictures on my phone and stuff like that.
So like, could we hire you to go do, like, tenant moves out, and we want to do one update, and it needs painted and carpet, and there's holes in 3 doors.
Absolutely.
You could do the whole turnover?
Yep. So I still have a 9 to 5. So basically I kind of market myself for like smaller odds and ends jobs. I can do a major renovation such as an addition, but let's say you guys buy a property, you need carpet ripped out, you need laminate flooring installed with baseboards and painting and all that stuff. That's my bread and butter. That's what I do.
So not licensed or insured?
I am licensed and insured. I'm a licensed builder and I'm insured. Yep.
And so you come out for estimates?
Yeah, free estimates. Yep. I'll come out and give you a price and yep.
How available are you?
So that's probably the best part. Is I'm not like a massive company. I have like a 1 or a 2 day turnaround. So I think that's.
Until he came and spoke here.
Yeah, well, right. But typically that's it. Like if you call me, I kind of pride myself on answering the phone and returning a phone call. Because a lot of contractors nowadays, exactly. You're lucky to get a return phone call. And I think that's business 101. You gotta return a phone call or at least acknowledge to someone like, hey, I got a job going on that's gonna take me a week. I can come back and give you an estimate within a week. But I'm also like probably another 2 or 3 days out max. Yes.
Do you have a crew that works with you, or is that something you do all on your own?
For the most part, I do everything on my own. Like, if I'm doing like a bigger renovation, like a kitchen, like I'm doing a basement right now, and I have 2 guys that work with me, but it's mostly on my own.
You said you had a nice job.
Yep.
What's that? Is that building also?
No, I work for Consumers Energy, so that's my 9 to 5. So this is like nights and weekends. So if you have like a tenant or somebody that needs a hot water replacement or something that's going to take, one evening, or a light switch or something, or smaller jobs like that, I'm available like on a night or a weekend. Yeah.
Do you do anything other than work?
No, I don't have kids, so you got to stack it, right? While you can. I'm married, so my wife kind of controls a little bit of my schedule, but. Yeah, right.
Just yours?
Mr. Hoffman, you have a big job coming up.
Right.
Gotta get money.
She's setting gears so we can make some more money.
Yeah. Well, thanks, Ed. Appreciate the opportunity. If you guys have any questions, like I said, my card's on the table. There's some up here. Don't hesitate to call, and I'll get back with you. Appreciate the time. Thank you very much.
If he doesn't do what he says he's going to do, I'll just call his identical twin. We've been beating on each other for. I actually met those guys when we were in elementary school. I graduated with their sister, and I think they're 2 years younger. Yeah. So they'll do what they say they're going to do. At least try. If they can't, they won't. They'll tell you can't. They can't. So the main speaker tonight is a CPA. So please help me welcome my Italian friend, Frank Alcini.
Hello, everybody. Thank you. I'm not a public speaker also, so I'll start out, I'll probably be a little nervous, then I'll start flowing. So, I'm a CPA, work with mainly real estate investors, real estate investor myself. Probably 95% of my practice is focused on someone with some aspect of real estate, construction, single family, multifamily, self-storage, wholesalers, flippers, construction, and everything in between. So I have a list of some topics that I get quite often from investors, and I'm welcome for questions that everybody has. Kind of what's the group made up of? Are we landlords? How many in here are landlords? Okay. Any wholesalers or flippers out there?
We got a few, yeah.
Okay. It's always anybody with newer landlords? Okay. So, anybody with multifamily? Okay. Any self-storage? Okay.
Commercial?
Commercial?
Yeah.
Okay. Okay, so I've done these before, and I could bore you for an hour with a tax formal presentation and watch eyes roll back in their heads. So feel free, bring any questions that you have, and have at it. Oh,
Okay, so question I have an at-home office, because I'm a landlord. I put in a driveway and I put a parking spot for when people come in because they come in the front door. Can I deduct part of that driveway cost?
so you're a Schedule E landlord, or how are you structured?
It's in my income taxes.
So you own your rentals personally?
Yeah,
and-
yeah, and then
Are they owned an LLC or your name?
in my name.
Okay, and then with a partner or anything, or
No.
just yourself?
Yep.
Okay, so generally with that, you're going to set that. There's a few ways you could potentially do that, set that up. And again, everything tonight is all just opinion and advice. It's general in nature until I know your situation specific. Please don't call me and say, well, you told me that 3 years ago at this meeting. Be more than happy to discuss anything, but with those improvements, you'd be able to set up a home office in your situation. And do you do any other real estate activities or just rental properties?
Just simple.
Okay, and then what are people coming over for, like tenants and contractors and stuff like that? So, yes, technically you can do it. On the one side, if you did a $50,000 renovation to your home and you own 2 rentals, it's one of those things, pigs get fat, hogs get slaughtered. Is it really worth the aggravation? But yes, at the high level is you're going to be able to take the home office deduction against some of that. A lot of these are questions I get. Client builds out their Bloomfield Hills basement, uses it for office, and wants to deduct half their house related to their business. That's something that's going to be a little bit more aggressive on that side. So that's why I have to say your situation probably worth looking at, but it would be something looking at recording it and then depreciating it related to the home office. And the reason I was asking is because if maybe did property management, had a different type of entity, it might be something that entity might actually pay you for rent of that space and structure it where it was more deducted on whatever if those of you that have other entities in place.
So on the home, I just had a question on home office deductions. I know when you sell a property, you're filling out that form to determine whether you have to file a 1099, because if you live in your primary residence for more than 2 years, you don't pay taxes. But then they ask that question, have you used any of this home for business or rental purposes? She would have to technically answer yes, and then potentially have a 1099 filed. How would that affect the taxes on the sale of your personal home?
So on your personal home, if you get the 1099-S and it's your personal home, I wouldn't be concerned, but you could potentially have to pick up the portion that's subject to recapture. So let's just say simply $100,000 house, I deducted $10,000 in depreciation, and I sell it for $200,000, so I have a $100,000 gain. I get to exclude, but you're going to pick up a portion of that $10,000 depreciation because that was for business purposes. I have a situation right now, a client had a rental property, lived in it for the older 2 of the last 5 years, turned it into a rental, sold it. They're going to qualify for the exclusion, but they're recapturing part of that depreciation that they took while it was a rental. So if you do get a 1099-S on your home, it doesn't really matter if you qualify for the exclusion. Sometimes you get it if they didn't properly check that paperwork, but
Sounds good. Thank you.
okay.
Yeah.
Is there a fee for a temporary one? And is it a sliding fee and who charges it?
Okay, so 1031, are those of you familiar with the 1031 transaction? I saw quite a few heads shake yes, some no. So 1031 is a great strategy if you have a property. Let's say I have a property I'm selling. Those of us in the room that are a little bit older might remember the old home rules where you had to roll in your home sale into your new home sale and continue on. A 1031 is similar to that. So let's say I have a property for $200,000. I sell it for $400,000, but at the same time I'm going to roll those proceeds into a new deal. A 1031 is going to allow me to roll that entire $400,000 into a new deal and defer that tax to a later date. So 1031 is a great strategy. There's certain time limits. There's a 45-day window from when I sell the property to identify my new property. So unless you have a new property on the horizon, it's something you don't want to rush into. I wouldn't buy a bad deal just to defer the tax. But with the 1031, it's really going to depend on, you have to hire what's called a qualified intermediary. So quite often I get clients that call me, I'm on the way to closing and I want to do a 1031, what should I do? Called me 2 weeks ago and I could have put you in touch with somebody. So more on the single family side of things, a lot of the, there's title companies that act as a qualified intermediary. They charge a fee, roughly I'd say about $1,000, and what they're going to do is your sale proceeds they're going to receive, you won't take possession of them, and they'll hold them until you execute on your new deal. And it's not necessarily a sliding scale, because if you had a multi-million-dollar commercial property, it's going to be a few $1,000s, but not proportionately higher necessarily. I've seen fees for $8,000 and $1,000 on single families. So those of you that have multiple single families and are looking to exit maybe into a larger deal, you might have properties here looking to exit down to Florida or somewhere as we move on and retire. It's a great strategy. You can even sell a couple properties this week to independent buyers, pool them, and in 45 days identify my new property, and you can exchange 5 single family deals into a commercial short-term rental down in Florida. It doesn't have to, it has to be real estate, but not what we think of as like kind. Like kind.
Not a primary.
Correct, not a primary. So, but generally with a primary, you're going to qualify for a $250,000 exclusion, single, and $500,000 for married filing joint, which you can take every 2 years if you've lived in it 2 of the last 5 years. Did that kind of cover that question? So, okay. As I gave the, I've been working with investors for about 20 years, focused on, and one of my biggest things is, you know, those of you that are newer, really establishing some best practices on bookkeeping and getting a better understanding. It's and also being in rooms like this, you know, with the experienced investors and landlords and learning from them. So, though, how many of you are structured in entities or have partners, and what type of entity do you have? And do you have a partner?
No.
Okay, so it's
We work together, but we're not partners.
okay. Okay, and then everything, you own your stuff and you own your stuff, and you guys just work together? So. Okay. So it sounds like she should get a management fee.
I'm saying low income.
If you can't make money on family, you can't make money on anybody.
That's what my brother says, he's a contractor.
I have one question.
Okay.
Without doing a cost segregation analysis, is there any way to accelerate appreciation?
Okay, great question. I get this quite often. So, more on like a single family property that
Or
we're...
even like a little for you, like, because I'm in the middle of a cost seg right now, but the guy's saying it doesn't really make sense if the value of the property is not over $500,000 by the time you pay us $6,000 fee.
Yeah.
do the cost seg, whereas, say I have a little 6-unit and it's a $200,000 property. Can we accelerate the depreciation instead of just taking it over 40 years? Is there any parts of it we can accelerate?
Are you building it out, or, I mean, did you just buy it and its tenants are in it? And-
Yeah.
Okay.
Because it's got older roof, it's got older furnaces.
Okay, so usually in those situations, that's where working with the client, so you can, if I'm repairing it, probably not, because I'm going to explain to you all the rules related to a cost segregation, but with that, so when I go buy that property, you bought appliances, you bought furniture and fixtures and different furnishings related to that. First thing I would have probably told you, work out with your seller to get that established in the bill of sales. So whatever you paid for that property, at least you can peel out all those things. Now, as your CPA, I've got a bill of sale that shows you paid X for that property, plus X for the appliances, furniture, and fixtures. I'm going to capitalize those and take accelerated depreciation on those. If you just pay X for that flat property, IRS is going to default that you bought that property. So now if you're doing renovations, you're going to build out the kitchen, and your contractor says, I'm going to do that kitchen for X amount of dollars. I always tell my clients, get that detail, and first off, don't bicker with them about the itemized price once you've agreed on X amount, but can you get the appliances, the carpeting, the cabinetry, those are going to qualify for faster depreciation, and we've got the evidence without having to get a cost segregation. But what they're saying is generally $500,000 and above is about the sweet spot to start getting a cost segregation done. So
like on a furnace, do you have the numbers on a furnace? So like this property, for example, has 6 furnaces. So do you already have built in, like if the furnace, do you know the built in, like if the furnace is good for 20 years, if it's 10 years old, can we depreciate half now or no?
I mean, if it's not identified in the sale, I mean, really, you're not going to be able to. If it's something you're putting in, now I'd ask, is it a repair versus a capitalized item?
It's always a repair.
Yeah. I mean, unless it's not occupied and it didn't have a furnace in there in the first place, now that's a different story. But yeah, it's always a repair. And those of you in the room, are you familiar with what a cost segregation is? Okay. And see, I think that term's thrown out. Okay, so cost segregation is, for instance, let's say it really comes from, let's say I spend $5 million on an apartment complex. I've got gym equipment, land improvements, appliances. I could probably have $2 million of accelerated items. So everybody really talks about cost segregation at that level because my multifamily clients are getting that done, getting huge amounts of depreciation. So now we've taken that concept, brought it down to single family, to smaller properties, which is still going to apply there, but it's not really, you're running into the cost versus benefit there because it's not something that I do to have a true cost segregation study done. You need a financial and an engineering study, and you have to hire a professional firm that specializes in that, and they range anywhere from $3,000 to $6,000, depending on your benefit. Is it going to make sense, And they can usually give you an idea how much you're going to benefit from the beginning.
Yeah. So like for example, what he's saying though, is say someone buys a $6 million shopping center, and they cost seg it, and they get $2 million bonus accelerated depreciation up front, they essentially wiped out $2 million of income tax. So a guy could be making $2 million a year and buy a retail center, so now he's going to make more money, but do a cost seg and pay no taxes. So that's how the rich get richer, because they don't ever pay any taxes. So one of my partners has $2 million of loss carried forward right now, and he keeps buying, keeps becoming more wealthy every day, and still continues to pay 0 taxes.
I actually have a doctor client that he's an anesthesiologist, she's a dermatologist. He went down to part-time, so he works about 10 hours a week. He qualifies as a real estate professional, and he's buying larger deals, he's offsetting a very substantial amount of their income, and he's qualifying and getting large commercial
Yeah.
deals. So the whole fact of in smaller deals are great, and all of these, but it's really just, as you're saying, how the rich are getting richer with depreciation. And that's one of the concepts with the smaller, if it's a $50,000 rental, you're not going to have as much depreciation on a much larger deal. So
So you were saying earlier, like, if you bought that property for $2 million, but you could have made a deal with the seller at 50,000 was appliances and whatnot?
for the $2 million deal, or on a $2 million deal, get a cost segregation, but if it was something on a $200,000 property, I at least identifying as much as you can. If it's just a vacant home that you're buying, you're really not going to get much done without getting a true cost segregation. There is some of the do-it-yourself ones online that you can do, and I'm not sure if you've ever seen those. And they're not really necessarily worth the paper they're written on. They're all disclaimed. You can do them for about $800 online. I'd advise against that, just because IRS just released a cost segregation audit guide this past summer, and I think only has about one element. It's really an online checker that you can pay $800, and if you get audited, they'll come out and do the full-blown cost segregation for you. But as a tax preparer, I can't actually file that without all the evidence at the time.
But if I bought a new stove, I can't, 179?
Oh, with the new stove, 179 or bonus depreciation, but now is it actually just a repair? Now, from a lending standpoint, it may be something we want to depreciate and take the accelerated depreciation versus the repairs, because some of the lenders are looking at your repairs year over year when they're refinancing your properties, but they're adding back depreciation. I've got a situation with a client right now that we've capitalized much more than we have, still depreciating it, but they're in a better position with their lender right now. So just plugging it on the repairs, it's still worth capitalizing and maybe depreciating. But the biggest thing this year for 2023, you mentioned bonus depreciation. If you're not familiar with that, I go out and spend a few $1,000s on appliances, and they're going to qualify for 100% depreciation, either 179, which is only used for profit, so it's generally going to be bonus depreciation, and we've kind of got spoiled with 100%. That's gone down to 80% this year. It's going to go down to 60% next year, and go down 20% per year. I think that's really the biggest change on the horizon right now. I think in the long term, I don't necessarily see that going away. Bonus depreciation has been out since 2001, but yeah, I think it'll continue on in one form or another.
When you say 80% this year, last year's taxes or this 2023?
2023. So if you bought something if you spent $10,000 in 2022, you get a $10,000 deduction. 2023, you get an $8,000 deduction, plus that $2,000 gets depreciated over 5, 7, 15, or 27 and a half years. So you don't lose it, it just gets deferred. So his example of his client who's continuing to buy, or his partner who's continuing to buy, he's generating all these losses, he's locking in all that depreciation right now against future income.
And people hate Trump. Because he makes no taxes.
You have this up here, 1099 Venmo Cash App.
Yes.
I get tenants asking all the time, what's your Venmo, what's your Cash App? And I just tell them, I don't have it. So, because I know a guy who was managing an office building, and the old owner accepted 90% of the people's rents in Cash App. And it's these little mom and pop tenants, little clothing boutiques, people doing eyelashes, rents $300 a month. They just kept Cash Apping the landlord. And it became, once you get 50 of those people, it's a management nightmare.
From
Up to the
an
1099s.
Yeah, from an accounting standpoint, from a management standpoint, from an eviction standpoint, it's going to be a nightmare. That I tell clients, a bank, totally step away from that. I did hear about a service just recently 7-Eleven will let you go pay. I'm not sure if somebody knows about that, where I think then it gets deposited right into your account. I'm not sure what it's called, but in their case, they can walk in with a check, Venmo it, whatever, just at 7-Eleven with whatever number, and it hits your bank account. So I think that's a newer option I just recently heard about. Let them go deal with it. But as far as you accepting Cash App, Venmo, I advise clients don't do that. Get a check, get it into your bank account. But that note was for last year. Any of you do PayPal, Venmo, Cash App transactions just among ourselves, whether it's with friends, out sharing money. The IRS historically only had to report transactions over $20,000. Then they changed it to $600. So this year, 23, was going to be the first year you were going to receive it. They delayed that for one more year. So, but any of you ever have a contractor wants you to pay them through Venmo, Cash App, and I've had that happen. And it's really their wife's Cash App or Venmo. What they're trying to do is capture all that money. So, being able to track that and report that as your accountant, you've paid these different contractors through Cash App, Venmo, it becomes a real nightmare. Those of you that have student housing, I have a few clients that consistently try to accept that, stay away from that because they're trying to pay that way, make them go get a bank account. There's a number of ways that I don't know what that 7-Eleven option is, but that's a great one that they can go there, do their thing with cash, and it ends up in your account right away.
So if you pay a vendor $1,000 by any of those means, do you have to 1099 them, or is that kind of like, do you have to 1099 them?
So for instance, if I pay a vendor $1,000 through Venmo and then $1,000 through cash, at the end of the year, I'm going to give them a 1099. What's that going to be? $1,000 or $2,000? So I would say Venmo or 1099 him for the full amount if you're doing it. Technically, you don't have to do that because the idea is that they're getting. So if I Venmo you as a contractor and you have a business account, you're going to receive that. And that's the way that the law is actually written. But now if you're just Venmoing Frank's personal account, and a lot of people are using those and bypassing the business fees. So I would say you'd want to 1099 him for that if you're not specific. I mean, if you're paying, we've all bought something online, at Home Depot and paid via PayPal. Home Depot is not a good example, but if it was somebody that had a business account that accepts different forms of payment, you wouldn't have to because PayPal would cover that. It's just like using a credit card, and you wouldn't have to 1099 him in that because that's going to be a business account. That's the way that exclusion would apply. But if you're just sending it to their personal account, I would include it. It's not going to hurt. If it's somebody that you paid one time and you can't track them down, I probably wouldn't sweat that one, but I'd try to fix it going forward. So it's kind of one of those things. Technically, no, you don't have to, but is it a business PayPal? Is it, I'd say that this business would have a business PayPal. I, may or may not have a business PayPal. So if you're already 1099, I might add that in that amount.
If you write in the check, you have to write 1099?
So any business has to 1099 their contractors if they're paid over $600 and they're not an S corporation, C corporation. So if you're just paying me, Frank the handyman, to fix some stuff on 10 different properties, and you paid me $500 each, but cumulatively you've paid me $5,000, you'd have to give me a 1099 either in my personal name, and the way to get that is with a W-9. I advise clients give a W-9 to your vendors, and the best way to get that is when I go to get that check, give me the W-9, and if it might lead to an argument, give them that check.
So what's the penalty if you don't?
So
I got a fitness of what I thought I was going to get back.
I hear all day long on the radio, people attorneys advertising for people to come in and they'll file papers for them. And I'm wondering, I somehow missed the boat. I mean, compared to $25,000 an employee, I might have got 10% of that.
First off, in 2020, we had the PPP money, and then they came out with the employee retention credit. So initially, you had to have a reduction in your gross receipts by a substantial amount and retain a certain amount of your employees. And then in 2021, they came out with the second round of PPP, and then came out with another employee retention because we still weren't up and going. But what happens is, first you're going to subtract the dollars you paid on PPP. So let's just say your payroll's $50,000, of which you got $20,000 in PPP money and paid payroll with that. So we would say $30,000. But alternatively, could you have paid other expenses such as rent and some of the other qualifying, and tried to bump up your eligible payroll? And then from there, it's not necessarily $26,000. There's certain limits. If somebody's only paid $4,000 a quarter, most likely you're not going to get the $26,000. So there's a lot of advertisement right now. And when you said that you ended up getting, was it your bookkeeper or payroll service prepared the forms?
I was expecting 25,000 employees, and hell, I got 10% of that, you know what I mean?
So did you see the forms that went in?
I probably signed them, but I didn't.
Okay, so first off, I would double check what was prepared and sent in, because at
Is
least
anybody getting $25,000 an employee or 20,000?
Not me.
some are. So I mean, some are, but it really depends. I mean, but very few. It's not like.
Do you know it when you send it in, or do you have to just wait till the IRS send it back to you?
So on your 941, it can either be reduced at the time of filing your initial 941 or filed on an amended 941. So you're generally going to know what you get. It's not that the IRS figures it out. But I've had a few clients get a lot, but these are large property management, construction. Their payrolls are larger. They retain most of their employees. And when knowing that it was coming, maybe some deposits were held into the next period to have a quarter that qualified. But so there was some timing that can be done, but they ended up getting some decent amounts. But what you're hearing on the radio, and I was listening to the radio this morning, and I got inundated with about 6 of these different commercials.
So it makes me think I should have got more in the radio commercial.
Right now, it's kind of the biggest scam of 2022 and 2023 is what I can say. A lot of these firms are charging a percentage of that credit. So CPAs, attorneys, cannot charge contingent fees based off of tax returns, but a lot of these firms are charging, let's say you get $100,000, we'll get you this credit for 20 grand. Well, if I can get you 100 grand, you'll give me 20,000. And that's how they're doing it. Instead, I just bill you for 200 hours or whatever it is and tell you it's taking longer. It's some work to prepare, but I would assume what you got is correct. And I've already seen a client that went to one of these, and it wasn't myself, it was one of my partners. One of his clients went elsewhere and just got the 26,000 about a year ago, and they're actually already getting audited by the IRS. And looking back at these payroll forms, they were never signed by that firm.
Now, there are 2 PPPs, and so I got one employee retention. Does that mean in the future I'll get another one?
So with the employee retention, when it ran out and you didn't qualify, then it stopped at that point going forward. So I mean, you did get it, plus you got the PPP, and I mean, there's other companies got more or less, but you won't necessarily get any more in the future. And right now, they're marketing it under different names, you know, payroll credit, employee retention. I still get calls from clients that we actually did it. Hey, is this a new credit? No, we got that for you last summer. You've already spent that money, and Oh, I thought it was something
But
else.
whatever you did get is taxable.
You're going, on your employee retention, you're going to reduce your deduction. The PPP was not.
No, but the employee retention is a taxable money.
It's not taxable, you just reduce your deduction.
You lose an equal amount of money.
Yes, yeah.
So the couple that you were talking about, where the husband was a doctor and the wife was a doctor, are they filing their income tax together, like her earnings, jointly or separately? For the real estate, for the income and for business, are they filing all together, or are they filing all three of those separate?
Meaning qualifying for real estate professional, or just, I mean, they have some businesses that are flow-throughs, so that depreciation from the multifamily and commercial deals are coming through to their 1040 via their K1 from their partnership, and then their medical wages are coming on their personal return, which they're filing jointly.
I didn't say all those letters and numbers, but yeah.
Oh.
Yeah, so his income, her business, and then their real estate, did they file that separately or jointly? You said they did well because he was down to 10 hours. So was that did they file jointly, or was that all separate filings?
Well, they're separate filing returns, but the tax is paid at the on their joint return. So I mean, to give you a high level, I mean, she makes roughly $500,000. He makes about $300,000 part-time, and they have a little over $1 million in depreciation and qualify as a real estate professional and pay no tax.
So maybe
No income tax.
So maybe they didn't make that much. Maybe they made close to 400,000. Another couple.
Yeah, I mean, but the biggest thing is that the one qualified as a real estate professional in that case, because his hours from his part-time job are substantially low, and he met the 750-hour requirement in real estate, and it was his greatest activity, so he qualifies as a real estate professional. So it freed up all those losses. Now, if you get two husband and wife, let's say they're both doctors and make $500,000 a year and invest in apartment deals and get $1 million in appreciation, they're going to run into the passive activity limitations. So it really depends if they're both working or not, or husband and wife, if they're working, if one spouse is working and one is not. Can we have the non-working spouse do a lot more so those hours qualify and become a real estate professional? And are those of you familiar with the real estate professional designation?
No.
Anybody not?
Please explain.
Explain it?
Sure.
Okay, so with the real estate professional, that's really the biggest thing that we were talking earlier that's going to trigger all these losses. That, for instance, let's say all I do is real estate, I do management construction, I have a bunch of rentals, maybe I have $100,000 a year W-2 in my construction job, and then I have a bunch of depreciation from my multifamily stuff, and then my wife is a doctor, let's say she makes $1 million, we're going to pool all our activities together, but those losses from that real estate, if I qualify as a real estate professional, and my W-2 in my business will count if it's real estate related, so maybe that wasn't a great example, but my W-2, as long as I have greater than 750 hours related to real estate or in a pooled activity, I can qualify, so all of my losses are going to get freed up as business activity, meaning that depreciation, and I can use that to offset my wife's W-2 and effectively wipe out hers if we have enough depreciation. So that's really where that real estate professional's the sexy part of taxes, you know. So if we had no depreciation and all we did was make money, that designation is not going to make a difference. But now see, alternatively, if let's say we're both doctors, both make a substantial amount of money, plus get all this depreciation, we're gonna be limited because most likely for doctors, we make greater than 150,000, and those losses, we won't get any benefit now, but they'll carry forward in the future.
How did he document those hours though, those 750 hours? You said he had to work at least 750 hours, how did he document that?
Time logs and just with his mileage and his time and he would only work so many hours at the hospital, and that's a very rare case. I've never had anybody that has a 6-figure part-time job that he's the only person I've ever seen, but generally it needs to be but usually it needs to be something that it's your greatest activity. You're generally going to qualify or you're not.
In that vein, I was going to say, you made it evident that you had experience in a lot of unique, nuanced scenarios that maybe that shoe may fit a handful of people's foot, but not fit everyone else's. At least lets us know that you're a person we can go to with creative stuff if it comes up to. I'm thinking that there's probably 2 other dominant things that people do in here, which is wholesale and flip. And I know that there's some tax consequences, capital gains, that people may or may not be thinking about as it pertains to flipping and or wholesale. Is there any snapshot of insight you can give in that regards to that?
So when you say flipping houses,
Bought a house for 50 grand, put 25 in it, sold it for 150. I just made $75,000 and I'm feeling great about it until I get the tax.
do I only do 1 or this year, or do I do 10 a year?
Maybe you can talk about both.
Oh, so I mean, if it's Frank Flips Houses Incorporated, and I do 30 of these a year. I mean, a flipping company is really just like a construction company. It's going to be ordinary income, and
And I'll say that's probably the exception for this group. That's probably the exception.
Not many people flip 30 houses.
Yeah.
10, 12, 30 houses. You might have a handful of folks in here though that may flip 1 or 2 and are banking on that $75,000 that they think they just made, but may or may not be thinking about the tax consequences.
oh no, I know. I'm just.
Okay.
I don't like the word flip. It's fun. We've all seen it on TV. Flip is ordinary income subject to self-employment tax. Improving an investment is capital gains. Could be short-term, could be long-term. I could have a bad flip that took over a year. Now I've got maybe an improvement that, COVID hits, firehouse permits, stuff, the deal that was going to go quick, had one of those, took over a year, and it was really improving an investment that qualified as long-term capital gains and now that may be a situation that what are you doing and how are you structured? If I'm in the wholesaling business and I wholesale 10 houses, a year, and I flip 2 houses, and then I've got a separate LLC over here that has all my buy and hold activity. That's why I'd say that flip house, I usually encourage my clients, call me, what are you going to do? Because, well, I'm going to probably improve it. Is it in that same neighborhood you own rentals? Well, maybe you should buy it in a separate LLC, because everything is defined by the taxpayer. There is no rule of thumb. If I flip 1 house, 10 houses, 50 houses, the taxpayer is not me. The taxpayer is my tax filing entity. And I'm married, my wife and I can have a partnership LLC that one is our buy and hold, one's our wholesale, one might be a shopping center, and then I'm not into getting into multiple LLCs for multiple rentals, but maybe I have my buy and hold and I set up a new LLC for that property I'm going to improve that I might turn into a rental and transfer over to my buy and hold. But if the market continues to appreciate, I might sell it at a capital gain and keep it out of my active ordinary wholesaling business where I do some construction consulting, because that's all ordinary income. So it's going to kind of go back to who has the title on that of that property. So yeah, I try to shy away from, we like to be flippers, but that's higher tax, so $75,000, do you want self-employment, and and then that structure with that type of profit. Now, if it's going to be ordinary income, we might want to look at structuring it maybe in an S corporation entity with some payroll and something like that. And if it's a one-off deal, or are you getting into this and going to start to do a few a year, and what's going to make sense for you the most? But yeah, definitely with taxes, usually newer investors, I tell them, plan on 25 to 30% to try to stock away to be ready for taxes as we get closer. You make 75 grand, you probably had some marketing, some other expenses, other things that weren't part of your deal, that mileage, things, we could probably whittle that down a little bit, but not substantially.
Thank you. I think that's the big piece sometimes. At least I've been there. Where I was like, I bought a house cheap. You know what? I thought I was going to rent it out. I'll just sell it, make a few bucks. And I'm thinking, even on a small scale, hey, I bought a house 15 grand, through 5 minutes, sold it for 40, great, made 20 grand. But the short-term capital gains on that, I might have been better off just rent it out for a year and then capture the shorter-term capital gains and get some cash flow along the way. It's important to have a professional to talk to.
And be able to structure that. Now, if the market crashes and goes the other which way, I'm going to change my tune and say you really wanted to be flipping houses, because if you lose money, that's an ordinary loss that we can offset other income, where your capital loss is carried over to $3,000. My home builders didn't pay taxes for years to come in 2008 and 9, but my real estate investors had some nice capital losses to carry forward. So again, it really depends how you're structured.
Thank you.
Any final questions before we wrap it up?
Can a flipper use 1031 or is there a minimum of time?
So again, if it's an investment, 1031 applies to investment and rental properties, not inventory. If it's more of an ordinary that you're construction, you're a home builder, you're flipping houses, that's really all treated as inventory. So it's really not going to qualify because it's ordinary. But it may be something that you have a house, it's being improved, was it going to be a rental? You decided to sell it. It may or may not, depending how it's structured. And see, with smaller real estate, sometimes it can get a little gray and fuzzy, and the IRS is generally going to err. They might tell you one thing and you a different thing. It depends what's going to be in their favor. It's like a C corporation, everything should be dividends, and an S corporation, everything should be salaries. So again, it's going to depend. If we were talking $1 million deals, you could separate these with separate entities and operating agreements and business purpose and clearly define that,
Make sure you don't get classified as a dealer.
Yeah.
Thank you. Thank you. Oh, how do they contact you?
I'm on all the different social things at REITAX CPA. You can find me at reitaxcpa.com, or you can reach out. My number is 248-461-3120.
He's going to write it up.
Yeah, I brought these.
I bet if we Google your name, it's fine.
Yeah, exactly. I don't know how that's good. What does text tell me?
So you guys can find me at REITAX CPA 248-461-3120. If you text that 20 to this number, it'll take you to my, it'll send you a link to my calendar if you guys want to chat further. You guys can book a time. Usually, if somebody calls me, if somebody calls me, usually I ask them just to book the calendar so we can set a time. Many times I'm working on one client stuff and it's easier to set a time and we can talk further. If it's somebody that you book a time and it doesn't fit, you know, I usually tell people just book a time. I've got some limited times, but if you told me, you know, only noon on Tuesday worked, you know, book a time and I can move it, you know, something like that, you know. So feel free to reach out if you guys have any questions. Go from there.
Thank you.
So thank you guys for coming out. And thank you. I hope that will help you guys with your taxes in the coming years. With taxes, you guys need to plan ahead. It's harder to not pay a lot of taxes if you're always looking in the rearview mirror. Like it's almost too late for 2022. Now you need to think about your taxes for 2023 as you make these investments. And that's the biggest thing I've found, because I'm like, oh my gosh, I can't cut a check for $100 grand. You need to figure this out. And they say, it's too late, because you can be doing a lot of things ahead of time. And maybe you're planning to buy a new car, like I bought one for my wife last year and one for myself this year, just to, you know, you're saving, it's almost like it was 33% off, just because of, you pay 50 grand for it, or 60 grand for it. You actually only paid 40 because I was giving 20 to the IRS anyways. So just trying to, and they were all in December. So feel free to get a hold of him. Thank you guys for coming. Our next meeting is March 13th. I hope you guys have a blessed week.
Okay, hold it. Did you ask about new members?
Sorry. So, is there any guests in the room today? So thank you guys for coming. Membership for the GLA. Membership for the GLA is typically $197. If you do want to join tonight, it is $147. There is, did you put applications on the table?
Yes. I did.
Okay, there is applications on the table, and Amanda is here. And if you're here and you call tomorrow because you don't have your credit card or check or however you want to pay, feel free to call tomorrow and still sign up if you'd like to. We do these meetings once a month. There is some online trainings, and you get a whole value pack full of all the forms and stuff that you would need to be a successful landlord in Genesee County. So thank you guys for coming. If you have any questions, feel free to go to anybody that has a little tag on if you have any other further questions. Thank you.
And the membership should be tax deductible and track your mileage to and from the meeting and other meetings such as this. You know, that's all going to be business related and related to the hours of your business.
Thank you for the report.
See you next month. Take care.
This is